Hey everyone, Douglas here, and welcome back to this Applied MMT Macro Recap. Is Stagflation back? Where do markets go from here? That's what we're going to be answering tonight. Of course, we're discussing stagflation because the GDP print came out this morning right at 8:30. The consensus expectation for the print was 2.5%, and we came in well short of that at 1.6%. Of course, markets sold off heavily right at 8:30 as that data came in, but by about noontime, we were starting to round that corner as we were down a little over 1.5%. And ultimately, by the end of the day, we ended up right where we began. And then after hours, after the Microsoft and Google earnings, we ended up rallying into the post-close time period to really end up much higher than where we began the day. So there's a lot to unpack here. But first and foremost, this question, the headline, stagflation is here, weaker than expected growth. Inflation prints continue to come in higher than expected. Does this mean that stagflation is in order? We're going to discuss that in the entirety of this video. But the short answer is I don't think we're quite there to that point yet. I think the print today, the GDP print, was a bit of an anomaly, and that ultimately I do expect growth to continue to remain quite strong. Now, that inflation component, that might be a little sticky and might be a little tricky, but at least the growth part, I'm not anticipating at this point that we're going to see a substantial slowdown in growth. Back to the GDP print, I think Ernie Tedeschi had the best take on this, that when you look at core GDP, which is effectively consumption and fixed investment, that still grew at 3.1%, a very strong print, and that likely the weakness has a lot to do with the strong dollar and what the strong dollar meant to net exports as it pertains to GDP. Again, I think what is most important here is the fact that the components of GDP that are most sensitive to those underlying flows that we know to look at, government spending, the fiscal channel, and the bank credit channel, those remained very strong here. So I'm not too perturbed by the fact that we had this miss. And I also think, despite markets selling off, that is how markets read this as well. I think markets are still hoping for a rate cut. Now, markets are not MMT informed. Markets don't understand that the 2023 rally we've had in the start here in 2024, a very strong push higher, is because of those higher interest rates, making sure that additional interest income is finding itself into the private sector, boosting prices. They don't know that. They think they want the lower interest rates back, and certainly their discounted cash flow models and their earnings projections bake that expectation in, and when that expectation isn't met, they need to reestablish a lower baseline for their estimates on prices. And that's why I think that the market actually read the GDP print the way that I'm reading the GDP print, that in fact it was much stronger than they were expecting despite the headline number, or at least the core GDP, the internal, is still showing very strong growth that the Fed is going to look at and say, nope, we can't cut yet. And because of that, because the expectation is that we might still get one cut for the remainder of the year, that the market wants that, it ended up selling off. That's how I'm kind of reading this, and that's why I think, at least in the short run, certainly those hedges were pulled or new hedges below price were made. We had the brief adjustment. That dust settled, and then just the reality of the underlying flow started to kick back in by the finish of the day. And so that's how I'm reading this. I think by next month we will see that this was a bit of a one-off in terms of a lower than expected GDP print, and growth continues its push higher into the end of 2024. To kind of drive home this point even more, if we bring up the 10-year yield here, it ended up finishing up more than 1% higher on this news, likely because those in the bond market and the treasury market know that there's just no way at this point that the Fed is going to cut. If anything, a rate hike is looking more and more likely, maybe not by the end of 2024, but certainly into early 2025, we might start seeing another rate hike cycle. So the 10-year yield finishing above 4.7% by the close of today. And if we look at the CME Fed Watch tool, let me go through the months: May, June, July. The predictions going out right now based on the Fed funds future rates are all pointing towards a no rate cut. Now, even maybe hinting at a rate hike again by the end of this year, if not early next year. So there is, at this point, my read of this is that the market didn't see the GDP print as bad as the headline number came in. If anything, the markets digested this as, there's no way the Fed's going to cut. That's why there was the initial sell-off. That dust settled, and now we're back to just kind of normal business as you will. And again, this is exactly what we called out at the beginning of the month. Remember, I tweeted out at the beginning of the month the fiscal flows were going to collapse into April. This would create a very brittle market. We were expecting a sell-off. I tweeted out the chart on deep MMT about how deep MMT was expecting a deep sell-off down to about that 49.50 level. That is exactly how things played out. And as I mentioned in that tweet, this would give a great opportunity for the bears to come in, kind of reestablish what they think is a little control, only to allow just a very healthy price reset and the resumption of that rally once the flows start kicking in. And I think we'll see those flows come right back on board as we head into May. So that's my take on the GDP print today. Now, there is one other thing, though, that we need to be aware of, and that is what is happening in Washington, D.C. and the Biden proposal here on capital gains tax. And this is a thing that we need to look at in the future that will have future implications here. And the reality is, or the proposal is, that capital gains tax gets raised to 44.6%. With also not only just a capital gains tax, but an unrealized capital gains tax at 25%. Now, I tweeted out on top of this that it looks like I might need to move forward my expectation for when we get back to recession land, and actually got a response back from Stephanie Kelton saying, look, don't worry about this. This doesn't have the votes. And I agree. This exact proposal may not have the votes. But the thing that does concern me here is across the board, left and right, there seems to be a commitment to cutting deficit spending. Now, from an MMT framework perspective, deficit spending is adding net financial assets to the private sector. So if you cut that, you're removing net financial assets from the private sector. And if you raise taxes enough, you make enough spending cuts, you can find yourself in a surplus situation where, when it's all said and done, in net, you're actually removing net financial assets from the private sector. We've seen this play out. We saw it play out at the start of 2022. We saw it play out in 2008. We saw it play out in 2000. Every time in our recent memory, going back now decades, every time we find ourselves in this position, it leads to recession. It leads to a bearish market. So if there is some consensus on cutting spending, taxes start rising higher and higher, some form of that where it's targeting deficit spending, we could see ourselves get closer and closer to a scenario where, especially in real terms, we're running a budget surplus, and that would lead to almost a certainty of a recession if we get there. Now, this is still very much into the future. We'd be looking at 2025, 2026 until this reality was seen in full, but again, what we need to be aware of is the political chatter, which is going to lead to the political decisions that would slow down the spending train that we've seen, that has supported this bull run that we've had. But this isn't an immediate risk. It is something to keep on the radar, though. It is something to keep at least on the back burner now and know that is a potential threat. As it stands, that's what we have for tonight. If you're new here, make sure you get subscribed, hit that notification bell. And if you found this video particularly helpful, make sure you give it a thumbs up on the way out. All right, until next time, good trading, everyone. We'll talk to you then. Bye-bye.